Inflation trades have been running wild, and if you've been watching this channel, then you should be in the positive direction. But is it becoming a little bit too much for the Federal Reserve? And what does it mean for all of us as traders moving forward? Do we now need to be starting to get concerned about certain areas of the market? Well, Fed Chair Powell said it's too early to tell, but we know that price action tends to lead the way. So which levels should we be watching? Today we'll break down the negative gamma areas for the markets for the very first time. And of course, the idea that options markets within bonds are starting to spike again. This is now the biggest spike that we saw since the sideways market back in January. Does this tend to lead? The answer is quite simply yes. And today we'll discuss that along with the key levels for the S&P 500 and the massive silver squeeze that's almost already there within 2 days. Let's get into it together right now. Well, welcome back everybody to The Daily Show. My name's Tom, and today we're going through all of this and a lot more in terms of the markets that are moving around the world. Remember to subscribe and hit that bell icon if you love markets, because there is a lot that's about to happen, and I believe some big price action vol is just around the corner. Let's talk S&P 500 and commodity trade advisors. For the first time in a little while, they started to sell. Now, we know when CTAs start to sell, we have to be paying attention ultra to the price action in markets. There's been a couple of false alarms along this rally, but we know one of the big ones is going to be the NASDAQ, because if we make a lower low here, that's going to signal that they're finally dumping their positions. Now, what will that usually bring? Some type of correction in markets. So just remember, CTAs are max long specifically in the S&P 500, and we must be paying attention to this particular lead indicator. Another one is copper. We've talked about oil, we've talked about, of course, gold, and we've been on the right side of those. They've been flying. CTAs first alerted it to us, price action then followed, and it was an excellent trade. But copper has also broken out, and we've talked about this quite a few times, but CTA started to buy it up big time and it just made a new high on these markets. Let's take a step back though and understand where we're at. We always want to know where we're at in a market before you start to make wild, rash decisions anyway. You'll notice here that if we take a 1975 chart all the way to 2024, you can see which particular sectors in the market are biggest and whether we're in, maybe something like another infotech bubble. I like to think we're not, because of course we use the internet way more than we did back in 2000s, but financials will be something that I think is worth watching in the future. If this starts to become a huge section of the market again, and in particular debt flow becomes big, you already know my opinions on this. Follow the debt and you will get quite a lot of information. Also notable that utilities, materials, and energy are really small nowadays. They are way smaller than they were during this segment here. And in many ways, I think that we're going back into one of those segments, or even this area around here, where we had big movements in the energy, materials, and of course, that space in general. In terms of earnings, energy is actually 8% of overall earnings. It certainly isn't 8% of overall allocation. And financials are a big 21%, again, underallocated considering how much earnings are there. It's because these particular businesses, Wall Street has figured out how much they grow, what they tend to make, and infotech is actually only 20% but makes up 30% of the allocation. So let's talk larger cycles. It's always great to have a top-down approach on where you're at with a market so that you understand whether it's better to buy the dip or actually be terrified. In this case, it pretty much is a buy the dip style market. And we've kind of argued this for quite some time. The medium duration is not there yet. In fact, it's still only around 2/3 of the way through the usual mini cycle in terms of moves. And the medium magnitude, that is how much we expect to return from these markets, is also not being hit. To give it another kind of way of being able to view, here's a clock version of it, and you'll notice where we're at and where a lot of them tend to peter out. In fact, there are some that go a lot longer than others. So what are we expecting? Well, usually you expect smaller pullbacks within the larger moves. Anywhere in the vicinity of 5 to 8% is pretty common. And actually, if we got 8 to 10%, that would pull us back to a very, very nice zone. But is it possible in this market? Everyone's, of course, incredibly bullish. A lot of it has to do with a pullback in time in some of the hottest asset classes, and more than likely some type of negative gamma switch that's going to come soon due to what Goldman Sachs has been saying about the market, and of course what we've been starting to see appear specifically this week actually with the jobs numbers. More on that coming up a little bit later on the show. So what about the materials, the energy, all of those sectors, the real assets? Are they still running? Well, again, I think they are. Now, will they have pullbacks? Yeah, absolutely they will. But it looks like we're going into potentially a very important time for energy, materials, and the gold sector. The question then becomes, are we in stagflation? Now, I asked a few of you whether we were. A lot of you said yes. But in general, to get a stagflationary environment, what you're looking for is you're looking for slowing growth and rising inflation. That usually puts you in the stagflation environment, a very rare environment in the markets. At the moment, you could argue that we're in some kind of maybe rising inflation and a little bit of growth, which is putting us back into the gold trades, the commodities trades, and possibly even the value versus growth trades moving forward if this continues. Are gold and silver stocks looking really good? We've argued this for quite a few weeks together, and so far things are really good. You can see it's a sea of green in terms of the percentages of the stocks above. It's the same for the energy sector. Most of the stocks, in fact, all of the stocks are above the 50-day SMA. They're mostly all above the 200 as well. And it's been energy, materials, industrials, and financials that have actually been leading the market now for around the last 3 to 4 weeks. The same thing's going on when you're talking about members at 3-month high cycles, a lot of breakouts in the energy and financial sectors. And it means that the breadth's improved in markets. And of course, the markets overall are healthier. But as we said, Goldman Sachs have a couple of things that they believe are overvalued in this market. And of course, it's probably in the AI space, the hyped space right now. And we saw that NVIDIA a few weeks ago dropped a large percentage of its stock. And then since then, it's gone sideways. Now, I wouldn't call it much of a prediction, but of course, we talked about the idea that a sideways market, a pullback in time, or even a small drop off in the semiconductors market was probably due. It was the more likely scenario. And so far, that's been coming true. Between 2 and 4% is what Goldman project the next 6 months will look like. But I'm here to say that I think there's going to be way better percentages in certain sectors of the markets. Let's figure out, though, whether the bulls are still in control. And the answer is yes, because we know we're holding above the daily 20 moving average. Now, stick with me here because there's quite a lot of complexity that's come in over the last 24 hours. We've got a series of course, higher highs and higher lows going through these markets, and every 20 moving average has been very big. As we pointed out, when we've had a gap down and we've gapped back up, markets have tended to fly and continued in their trend. And that's how it happened 7 times overall, with this being the 8th time. One of you said the 8th time's the charm in terms of seeing a market turnaround, but it's going to come down to, I think, the 0 DTE options, which we'll go through in a moment. So let's have a look at this particular strike. The market opened up a little bit down. It rallied through the session, and then you can see here a wick near the end of the day. So let's scroll into a 5-minute chart to understand the market structure of what really was occurring. It was pretty much rally, and then drop with a small pickup in the end of the day. You would call it a almost partial loss to the bulls because they weren't really able to break through this market structure on the left-hand side, nor were they able to fill the gap, which a lot of traders were looking for. And where it closed was pretty much the perfect level for the 0 DTE options. Let's take a look at our breakdown of the key levels using a futures market. So we know that, of course, we have call resing sitting around 52.75. We have the most traded zone in this recent structure sitting at 52.34. And this was a beautiful little hit in the last couple of minutes. So you can see that it came up, it hit it, it found this structure, and then it saw a little bit of a reaction. Now, if markets move back down to these lows, that's when things are going to get a little bit scary for the bulls. They want to protect the 51.75, 51.80 level. We've talked about this being a heavily traded zone, and a close below is most likely going to bring the negative gamma switch. Now, a few of you mentioned that, yeah, but the negative gamma switch has already started at 52.25 in the previous session. The markets managed to hold right around that zone, so they didn't really have to hedge it off. I think that when you break technical zones with options, that's when the power of options really comes through. So we've got an anchored VWAP, we have market structured demand, and we have a key level. So the bulls, very happy as long as markets hold above here. And a super bull move would be something like this, followed by a rally. If that happened, new all-time highs seem very likely. And there's going to be some great trading around these markets moving forward. Be careful around the 52.35 to 52.40 range. Again, another high above 52.50 should bring positive gamma back into the markets. And of course, hedging will go towards the upside. I tend to think we might chop into non-farm payrolls. It's pretty normal, and we might even be down at these key levels before non-farm payrolls to see whether the big news event will break it down or whether it's going to break it up. If you're not sure what the non-farm payrolls is, it's the unemployment numbers that do matter for the Federal Reserve at the moment more than any time before. Let's go over the 0DTE options for the next 2 days. We now have, of course, our Thursday session, and we've also got our Friday session. And you'll notice there are puts everywhere. Now, a few other people in the comment section said, as soon as you mentioned puts, I bought the market. And that actually has been what's happened. They've acted as floors. And you'll notice we have a couple of HVL levels. This is where you're kind of switching between positive and negative gamma areas. And you can see here 52.25 is a pretty important zone. I like to use, as I said, technicals with the options. And notice the most struck level is 51.85. Below this is where I think the street would be starting to hedge. So over the next 24 hours, you remain bullish pretty much from a structural level until the markets really get underneath the 51.85, or you look at how the markets react around there. As we say, patience, react, don't predict. 5200 level is also important, and both of these zones, I think it's really the 51.85 you'll be wanting to look at, but take a look at these massive amounts of puts. Now we go to the OPEX of April, and you'll notice there's still a lot of calls. So it's starting to heat up in the put side. It's starting to heat up from that area, but 0DTEs will be where it's at to crack this market if it's going to. And for now, it's still bullish in terms of overall trend. I did post a quick thing over on our X account, following the links in the description down below. And I talked about how underneath 51.80 was technically going to bring in, I think, a lot of hedging. That's why that level managed to hold throughout the session. And I said buyers will want to hold this zone. Technically, we did enter into a negative gamma around 52.25 during the session, but it didn't hold down there. So they didn't really need to hedge. And I do think that these technical levels, again, with options are key. So where are we right now in the presidential cycle? And is it going to work? Well, it's at the point where you don't really expect huge gains usually from the markets, and a lot of rotation tends to come through. We've already talked about 2012 and 76 being the most overlaid markets to right now. We're sitting around here, and in both of those cases, they had pullbacks or pullbacks in time around this point. I do think it's important to note these. Of course, most of the data you'll be finding out is just basically bullish, bullish, bullish. But you'll also notice that all the comments down below and comments in X and everything else are all going to be, this market will never go down again. It will never, ever crash. It'll never do this. It'll never do that. Generally, that means that we're starting to get to that point where you're just looking for the technical reasons, but ultimately you just stay on the trend. Remember, it can go for longer than you think, so you must look for your actions. Semiconductors during April are a little bit weak over the last decade. So as we've mentioned, that's not really the place we want to be right now. We want to be in different markets. And Goldman Sachs are estimating that a 5% move has a 25% chance instead of what the markets are predicting, which is about 6% chance. We're well over 100 days, usually 67 days brings a correction. And these are the secular bull markets. So again, it looks like there's more to go in terms of the bull. If you're an investor, if you're somebody that dollar cost average, you're going to be really just saying, well, I don't mind a pullback because I want cheaper prices. And I'm sure a lot of people would like that. But ultimately, you don't mind it either if it keeps rallying up. And history would say that, yeah, it's going to keep doing that. There are sometimes hurdles with some of the overlays, 1950 versus 1980 and today. There are a couple of overlays here that show pullbacks. And again, we get similar ones when we look at 74 and 42. And I love these charts. I think they're excellent, and they really show you a blueprint of what's most likely going to happen in the future based on the previous history. In terms of unusual activity, let's have a look here at S&P 500. Huge amounts of dark pool activity sitting right around what would be the equivalent of the 5180 level. You know it's being defended, and the markets are trying to buy that zone up. You'll also notice that market structure on the left-hand side had some miniature trades in it, so it ends up being supply. It's not rocket science. That's exactly the two levels that we expect to be the biggest playgrounds for the markets. But Tesla getting downgraded by, of course, JP Morgan, and it went up 1% as soon as they found out about that. Why? I think it's because of that huge positional trade. Someone probably started to buy and defend that level, but if we take a new low on Tesla, other than it instantly spiking back up, it could spell very bad things for the stock. 150, just like that, could happen. So I think we'll need to be paying a lot of attention to it. The VIX is also one that we should set alerts for. Remember, it is currently shorted from the short vol levels. So if we get above 16, a lot of those will need to be cleared up, and that could cause a squeeze. All of us are probably familiar with squeezes by now, so that's nothing new. And in terms of the market rotations, you'll see here it was up, down, and all around, with most of our favorite sectors recently doing very well. Metals, number one, beautiful. Gold, beautiful. Clean energy and solar coming back in, and energy also doing incredibly well. So it was a pretty nice day across the board, and it takes us to the last 5 days really being not about semiconductors, not about tech, but being about what everyone now is talking about. And again, I'd like to think, give it a like if you like these videos, because I'd like to think we were on this quite a lot before anybody else was. Let's now talk about the charts. So first up, as I said, the 16 level. We should be setting alerts for that on the VIX. Very important. This is something that I found very strange. And what it is it's high yield bond options. They spiked. Now, if you've been watching the channel, I cover this quite a lot. And because when we see these spikes, my alert got set. So I set an alert here and we got an alert off. This is a warning sign. It shows that if we do break below, it could be real, because we've had several other times where we've got early spikes in the high yield options and then the market's turned a little bit. The last notable one was most likely back in December of 2023. And we also had one that spiked back in July that led into, of course, more spikes across the board. It's a good little early warning sign, and it can be used with a few other things. Central bank liquidity, of course, also dropping over the last week. Small injections here. Maybe they feel they took a little bit too much away and the market started to pelt. But we do know that, of course, they've been accommodative. But for now, a little bit less than there was 2 weeks ago. US 10-year will be needing to be watched. Of course, 2-year, 10-year, all of these alerts, set them 4.4. Most likely they won't move too much until non-farm payrolls. And we already know Jerome Powell saying the same thing as usual. It's too early to tell. We're data dependent, blah, blah, blah. Same thing, same thing. For treasuries traders, could this be an island reversal towards the upside? Look for gaps if we do end up dumping on all of the yields, because of course yields are up across the board. I tend to think there's a real possibility of going to that 89-90 zone, which I've had for a little while just in case. But I do remain bullish on treasuries after we get back down to those levels, although they're not looking as good as they were a few months ago. High yield bonds, what's going on here? Well, we're back down to the lows. Now, we know that this means risk off or risk on. So if high yields go below these lows, maybe 76.50 is worth setting an alert for, then that's telling us risk off. If that happened when the daily 20 moving average is also being broken by the S&P 500, we turn into a negative gamma environment. You can kind of see how that's putting the pieces of the puzzle together better than we've ever seen in the last 3 months. The other thing is that if the bonds end up holding up and they start moving back in the positive direction, that's showing you that as we break through key levels, you need to get back on board the bull train, because basically it's risk on, risk on, risk on. Home builders, another one to watch. It does have an island reversal on at the moment, a gap up and a gap down. So if it continues through the 20 moving average, again, it's just a cautionary tale in the market. It's kind of like the canary of Apple. Sometimes if Apple breaks a big support, it can be a key deal. Dollar index could not hold the previous session, it actually fell off quite a big. And this is back down to support now. So day traders will want to be very much on this one, having a look very closely at how the market structures here. Remember, patience, react, don't predict. You might have a bullish bias on it. I think that's fair based on the weekly close, etc. And we are back in structure, but we don't have any recent price action movement. So no structure there. We'll update in the next 24 hours. Copper blew through. First target hit. Second target now set to 440 for copper. And been a very nice trade. Moving up. Gold hit the first target. Big 2,300. Congratulations, anyone that's been on this. I have more for gold. I actually think it's got quite a lot in it. I'm obviously a bit bullish on this thing. And I've made some relatively large calls, I guess, talking about 3,000 an ounce quite a while ago. Now, that's not going to happen anytime soon. I think it's probably a 2-year plan. But yeah, gold is looking good, especially if rate cuts do come later on this year. 2,300 though, I expect some structural kind of, wavering at this point. Now, where the real money's been at in the last 24 hours and 48 hours has been silver. Woo! Look at this thing. We alerted on the weekend that this was looking good structurally, and boy, oh boy, was it. Look at it go. It's squeezing and squeezing. It's trending. It's doing everything. 8.32% off that move. I still think it'll go towards that 28 kind of level, 27.80. So it looks like it's rallying up. Pullbacks to be met by bull demand. Very aggressive trend. Hard to get into if you weren't early on it, but very nice all the same. Gold stocks moving through really well. As we saw, all of them are above their moving averages. Sweet stuff on the gold stocks, really nice movement there. US oil and oil stocks, I think they're still in the middle of nowhere land. You can see it's a high and a low and an open and close at the same level, which is a long leg doji. So really, we're just looking for continuation. I think 88 is a very good target for US oil. And you also want to be watching Brent as well, because both of those are important. Semiconductors versus SPY, you'll notice that we have a sidewaysing kind of market here. So not much to report on overall. But again, it's what we expect, a sidewaysing market for now, with some weakness coming into maybe semis as we move through to the materials, the energy, the gold, the other sectors. Energy stocks on a massive tear. They've just hit a big overbuy, but the trend is still up. So just like with the S&P 500, like with anything, if the trend's still up, you might think that's ballistic. It can keep going for a while. But if it does keep going too much, I think it's going to have a little bit of a collapse. If you have a think about it, when we've had epic runs on energy before, they do have kind of nasty sell-offs that can then be bought up. And that's like any of the trends. We saw it on Nvidia. We'll see it on every stock. Whenever they start to do this and they run away from their Bollinger Bands and they run away from everything else, you follow the trend until pretty much the end in this case. Metals, also nice breakout here. Specifically, aluminium has been doing amazingly well. So that's a really excellent trade. And we've focused on that in our Market Masters Club. Links in the description if you ever want to follow along there and talk about some education and concepts of learning how to find better charts and better analysis. Tesla overall held its level. We know this is defended zone based on the large position that was placed over here. Can it gap up? Is that an island reversal then? Yeah, it would be. That's probably really what day traders will be looking at. Another thing you could look at is a new low with a spike above. And if it gets a close below, yeah, I don't think that's good. 145, anyone? Yeah, it's possible. Trend here is still down on Tesla, so you've got to be careful. Another one where the trend's down has been Apple. So a few people were trying to buy this. I didn't blame them in terms of buy it for the last session with little stops below this point. Yeah, it's a risky trade, but sometimes it'll pay off big time. And if we get underneath this zone over here, which is around 165, then I think that Apple could be the canary and really showing that the markets are starting to weaken across the board. Another one of interest was Google. They came out, and although the trend's amazing and we like Google right now, they're trying to potentially monetize their AI chat search. We'll see how that works out for them. In the new day and age, I think that monetization may not be the way to go. It's probably going to need to be ads or something. What about the overall Hang Seng? This is the Chinese market. Still looking good. Chinese tech stocks still cheap. On the price per book, we'll do something on that soon. They are really cheap and no one likes them. So the price action has been dictating that they are still very bullish. Same thing with the Aussie market, still looking good. 2 steps forward, 1 step back. Coming off the base here of 7769. That's exactly where you need buyers to regain. If we lose that, back down to 7650. Ultimately, it'll come down to the US markets, but the FTSE and the Aussie market are benefiting from minerals, metals, and all of that stuff, energy, etc. US 2K held its own. You can see here the overall ascending channel. We hit the top. We haven't quite hit the bottom. Do we have the structure that we like? Let's go and look at the 2 hours here. So there was a little bit of a buy. If you were a buyer, one thing you could do is you could look at the structure at around 265 over the next 24 hours. And that level there is a speculative buy kind of area from a technical perspective. Obviously, you've got to practice your own risk and everything, everyone. But yeah, I do like the fact that it's rallied through. It's found it. Is it the best zone? Well, we talked about this level a little bit. Maybe too early to tell, but an early kind of nice level for the US 2K. The Qs, though, weren't that good. They rallied, but really they've still held down. Technically, it's still an island reversal towards the downside. It's still maybe accumulation, maybe distribution. Watch the S&P 500. I cannot state it enough. S&P 500, 0 DTEs, CTAs, these are what we're watching right now, along with unusual volume activity. For Bitcoin, it's good and bad. We liked this wick. We obviously don't like it until it gets above 67 from a proper bull case. And if it comes back down here, I'm pretty scared for Bitcoin. I think 60K could be taken. I think we're actually going to do a special on, I'm just researching it at the moment, on halving events. I think you'll find that the average halving might actually give you this type of price. So that's around that 30% down. So realistically, this is a very important time for the bulls to hold on Bitcoin. And if they get it back down to that 63, I don't really like it there anymore. I could see it under 60. And if it gets under 60, 50, 1, 8, 50,000 is going to be a huge zone for it. For the week ahead, there's still some epic news, and it's going to come from the jobs numbers, unemployment claims on Thursday, although I don't think it'll move much. We've got Mester speaking at 2 p.m. New York time, and then we have the big one, non-farm payrolls or the unemployment rate for the US, 8:30 a.m. Watch it, subscribe to the channel. We'll see you in the next one. Heaps of opportunity out there, guys. Remember, come from the abundance mindset. It doesn't matter just because everyone thinks they have to trade AI stocks or Google or Amazon or whatever. You don't have to. There is so much out there. And I think that over the last month, you've really seen the power of other sectors. Good luck. We'll see you in the next one. Bye for now.